Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Justin Carbonneau and Jack Forehand are principals at Validea Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validea Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validea Capital.
Hey guys, this is Justin. In this episode of Excess Returns, Jack and I sit down with Harley Bassman, aka the Convexity Maven, and managing partner at the rapidly growing ETF firm Simplify ETFs. We talk to Harley about the concept of convexity, how investors can utilize it in investment strategies, and how some of Simplify's ETFs are taking advantage of this idea in today's market. We also get Harley's thoughts on the Fed, the economy, and where the opportunities are in fixed income today. As always, thanks so much for listening and your support of Excess Returns. Please enjoy this discussion with Simplify's Harley Bassman. Just one more thing before we start. Excess Returns has been growing a lot recently, and all of that is a result of the support from our loyal listeners and viewers. We just want to thank everyone who's taken the time to listen to us and for supporting us and allowing us to continue to reach more and more investors. If you have a minute to do it, we would ask one favor of you. If you have benefited from the podcast and could take the time to subscribe on YouTube or your preferred audio platform and to write a review, that would be greatly appreciated. Both are a big part of expanding the podcast and will allow us to continue to get great guests. Thank you so much. We really appreciate it.
Hi, Harley. Thank you for joining us today.
Thank you.
This is going to be kind of like a two-part discussion. I think we're going to first talk to you around education, investment strategy, ETFs. And then I think on the second half of the discussion, sort of getting your thoughts on important macro sort of trends, things that are driving the market and the economy today and things that are on investors' minds. But I think it's just worth out of the gate here, congratulating you and the Simplify team on what you guys have actually built over there. I was looking, the company is not even 3 years old yet. You have an impressive, interesting lineup of ETFs that are growing assets nicely. I think you guys manage over $1.5 billion as of today. So, congrats to you and your team.
Thank you very much. Modestly, what we offer is pure genius. It's very unique. We'll get to that soon. I came out of retirement to join the company. I was employee number 9. So I get to tell my kids I'm a startup.
Yeah, nice. And listen, it's hard. These finding unique, interesting ETF ideas that haven't been exploited yet, that are actually working for investors. I would have thought 2 years ago, all the ideas were already out there and have been, but there's always in investing different ways to look at the markets, I guess.
Part of it is the market has to be ready to take the next step. Also, you need regulatory, change to help. You could not use derivatives until a few years ago. Well, the big door was always closed. Well, but also people have become more sophisticated, more knowledgeable, more comfortable with, I won't say taking more risk. I will say with things that are a little different than just straight up buying an index fund.
We wanted to start with you around, I think, more sort of a core personal philosophy that you have written about and you've shared on your website. And that's this idea of the Maven mantra. So I was wondering if you could just sort of flesh out what goes into the Maven mantra.
Well, those are, I have my website, convexitymaven.com. I publish every 4 to 6 weeks. If you want to go and be on my list, just send me an email. I'll add you. It's all free. The Maven mantra, it's a level of character matters. I'm 35 years corporate Wall Street, and everyone that goes down, it's always, some character flaw. We read, Shakespeare and the Greek tragedies still, 1,000 years later. Why is that? It's because the story of mankind is always the same. It's hubris, ego. And that hasn't changed one lick. And, last week's newspaper, man, so you got to read. There you go again. Well, and so, being a good character is important. And then, of course, also having a life, okay? Go out with your family, go with your kids, go keep your priorities straight. Are important also. The graveyards are full of indispensable people. So those are the concepts. And then you could see one of Bassman.net for my family trips.
I looked at the pictures. You guys have been all over the place. I was like, where haven't they been? What a great experience for your children to do all that traveling with you and your wife.
We have hit all 7 continents, and it has been fun. And you should go to places that are different and unique, that are going to change in 10 years. There's no reason to go to Okay. Western Europe, Paris and Italy and England, they're not changing at 500 years, man. Go to places that are on the cusp of something different, like Burma or Antarctica, things like that. And you could also do trips also. I mean, we did 5 RV trips. They're easy to do. They're great fun. You'd be shocked how easy it is to manage. And also, I mean, going to see, the great national parks that we have is important to do. And we just, them where there's more European and Japanese than all American. It's kind of bothersome.
Yeah. Yeah. Those national parks are such a treasure that a lot of, Americans have never gotten to. But I wanted to ask you, how did you come up with the name Convexity Maven, or did somebody name you that?
One of the salesmen at Merrill Lynch, kind of said it, offhand, quite a while ago. And it kind of struck a chord with me as a clever idea. So I kind of adopted that. I'd like to say I made it up, but, I did. Although the Maven part I appreciate, because once upon a time, Bill Southcard used to write a, on language column in the Times where he'd dissect word histories, and he was called the language Maven. So I kind of like that.
I'll be honest, I didn't know that you were such a prolific writer. So I'm going to, after this, ask that you put me on your list, because I like to devour content, and you have a lot of interesting stuff on your website for sure.
Well, I just published last week about mortgages and REITs, which I still love. We can talk about that if you like.
So let's start sort of in a basic level. And this is more around, I guess, education. Our audience, we do have financial professionals that view our podcast, but we also have a lot of retail investors as well. So can you just talk about this idea of convexity and sort of explain it like you would explain it to someone maybe for the first time?
Like mom and dad?
Yeah.
Sure. This is
Me.
We use the word convexity because it has X's and a V. It sounds like fun. And then we have all the Greek letters. Just ignore that nonsense, man. We just say that to market great to you. Convexity is very simple. If you have called a bet, although we don't like using gambling terms on Wall Street, then you have a bet that can pay off 1 point if things go up and lose 1 point if they go down, equal, like up and down 10 basis points or up and down 5%, whatever it might be. If you make a point or lose a point, or an equal change, that's zero convexity. If you make 2 and lose 1, positive convexity. Lose 3, make 2, negative convexity. That's it. Nothing more, nothing less. It's just, is your return linear or nonlinear? And what that means in practice, this is why we hired all these physics PhDs in the 90s, is let's just say we have a bond, a bet that pays 4%, okay? And it'll go up and down the same, either direction. If I had a similar instrument that would make 2 and lose 1, it is clearly a better investment, all else equal. So you wouldn't pay 4% for that because you'd always buy it versus the other one. So maybe you buy for $3.75 or $3.50. You take a lower yield because it's a better performing instrument. The rocket scientists come in to figure out $3.90, $3.80, $3.50, whatever it might be. Similarly, if you have a thing that loses 3 and makes 2, like a mortgage bond, well, that's worse. You would never buy it for 4% if the other one, the flat one, yielded 4. So what should that be? Well, maybe that should be, 4.25, 4.5, 5%. That's where the rocket scientists come in. It's trying to figure out what their value is versus some benchmark. Now, the benchmark is usually treasuries, which are actually positively convex microscopically, but ignore that. And we have price off that. Mortgage bonds traditionally price 0.75% above treasury. That's it. They were as tight as 40 basis points, which is insane, over treasuries last year. But they're buying everything in sight. And if the Fed stopped buying, what's happened? They got as high as 175 last week when I published and said, buy these things at the wrong price. They've tightened it a little bit, but they're still the wrong price. Once you back out all the risk return, other things involved. And that's all it is. I made a career, was very unique on Wall Street, of almost always being long convexity, long option, long the positive profile. I would buy the option. When you buy an option, you have unlimited gain, unlimited loss, what you pay for. This is why you see all these, there's massive explosion in like 1 day, 1 week option trading on the exchanges now, is that we now have all the millennials who are somewhat proficient in math, recognizing maybe it's a dumb trade, but I could pay a point and make 10, and all I can is 1. That's not insane. Most Wall Street people before me who were involved in options would always sell, not selling the call, selling the put. They like it because they're taking the money in, but the most you can make is what you take in, and your loss is infinite, or at least much larger. When you buy a junk bond, what is a junk bond? Okay, it's a 5-year treasury and a default swap, an insurance, on the company. And because the most you can make is 100 when you buy a bond, what you can lose is that you can go to 0. You can go bankrupt. So if treasuries are 4%, maybe junk bonds should be, hitting 4% more. Is that enough? Usually it is. Right now, unclear. That's what you've done. All you've done is bought a 5-year treasury, the full name, default swap, the default option on a particular name. Everything like that. Everything is not treasuries if you sold an option of some kind.
So is it, just on one follow-up here, is it a measure of risk and return, or is it more a risk measurement?
It's not risk versus, you could make it risk versus return via various methods, Sharp, which I hate, or various low profiles. But at the beginning of the day, what you do is you basically take this instrument and you run some kind of, decision tree on out, 10, 20, 50,000 paths. You discount them back at some rate and you get a number. And what you're trying to do is back into where the two things have an equal present value. And using yield curve, using implied volatility, using all the other various inputs into it. But basically, this is the expression OAS, option adjusted spread. What that means is you take whatever the investment might be, and you back out all the embedded options or embedded, bells and whistles that are not the treasury or that are not the S&P 500. And you back them out and you see if the value is still above or below the basic core index. And the idea is to go buy something that's trading above that core value. So you're actually making money above and beyond the value of all the options.
Can you give us just a few examples of investment strategies that are taking advantage of sort of this convexity concept, actual ones that are running in the real world?
It's tricky over here. I'll give you the negative strategy. People who invest in a buy right fund. A buy right is you buy the stock and sell the call. So you have limited upside, unlimited downside. Right, stock can go all the way down, and the most you can go up is 5 or 10% when you sell the call against it. That's a short convexity strategy. Is that a bad idea? It depends. If the VIX is trading at 9, it's probably a bad idea. You're selling that call at a low level. The VIX at 40, it's probably a good idea to go do that. We offer an interest rate hedge product where we offer a 7-year put option on the 30-year treasury. That's not that, but it's very close to that. And there in that product, you long the option, you want a 7-year option that wins if rates go up and loses if rates go down. And to the extent that you have a portfolio that does poorly if rates go up, well, then you want to buy this because it's unlimited gain for unlimited loss. We have another product we offer where you put, if you give me $100, you put a $98 into the S&P 500 and $2 into out of the money puts, an insurance policy. So in theory, the worst you're here will lag by 3%, but if disaster strikes, you have a blanket, a big pillow you can land in. So that's interesting over there. Another product where you go and you invest in ordinary junk bonds, like a junk bond index or ETF, And then we add in this nifty little, it's called quality versus junk. It's a professional product only available to the pros, but we're the pros because we're the only guys out there with ISDA. ISDA allows you to trade with Goldman Sachs, Morgan Stanley, PIMCO, BlackRock, and all the big guys. We're even putting all of them. And what this little thing does is the pricing between a quality credit and a junk bond credit is a little mispriced. And therefore, when you take this product from a Goldman or a Morgan Stanley, if bad things happen in the credit market, this thing will actually do better and will cushion your loss. It's basically like a long put option on junk bonds that is basically almost free. It's a complicated product, which is why you buy it from a Wall Street dealer who manages it for you. But I mean, we have this and we put it, and it worked. So it's a clever idea. What we really do in many respects is, at Simplify, is two big ideas. One is, we try to add convexity, optionality to an ordinary portfolio. I'm not going to tell you to buy stocks or bonds or this or that. I'm just going to say, if you want to buy it, I'll give you a better profile where it goes up faster and down slow. That's it. You can make your own mind about stocks and bonds, man. You make my problem. I just make it a better return by taking derivatives and putting them into this ETF, which is basically allowed now that was not allowed 5 years ago. And the other thing we do is we go and have access to professional products via this ISDA. And so we can offer professional investment strategies to what I call civilians, non-professionals. And getting ISDA is, after Dodd-Frank, is rather challenging. Used to be pretty easy to do. You could be $100 billion hedge fund now and not get ISDA from a Wall Street dealer. We have one that we trade with Goldman, Morgan Stanley, Bank of America, and Barclays, and two more coming online. So we even footing with all the big boys.
Yeah, what really kind of made the light bulb go off in my head about the benefits of convexity is this idea that if you have a convex product that moves against your core portfolio, and if you're willing to rebalance that convex product when it has its convex return while your portfolio is going down, you can increase the return of your portfolio even if that product has an expected return well below your portfolio. So the idea of like rebalancing during those events can actually increase your return. I mean, you can tell me if I have that right, but that was really when the light bulb went off in my head.
Well, you have stumbled into the truth, miraculously. So in Chronic, we offer where you buy the insurance policy, right? Market drops down and there's 2% you've invested in the puts, right? The insurance policy, all of a sudden it is worth 5%. What you can do is sell that thing off, take 2 of those 5 points and rebuy new puts, take the 3 points and buy more stock. And that is very clever because basically if you would down and bounce back up, you instantaneously reinvest at the lows and capture that. Whereas most people will have their equity exposure and then have, they'll go to some hedge fund that offers an insurance product. You know who I'm talking about. And the problem then is they might win, but your money's stuck there for 2 months till you can get it out. And you have to pay taxes on that gain. It's very inefficient to do that. So we've basically taken, like I said, we haven't invented the wheel here. We've taken good ideas and improved them. That's all. We put them into an ETF format that you can trade on the exchange. Point and click, really easy. And the strategies are relatively simple. It's just putting in professional products into something that's just so unique that it seems new, but really it's not anything earth shattering.
I want to ask you about inflation and a lot of other things going on in the economy. But before I do that, I was listening to an interview you did, and you made a statement that I thought was really interesting. So I wanted to ask you about it. What you said is that sizing is more important than entry level. And I'm wondering if you could just talk a little bit about what you mean by that.
Yeah. Okay, look, you are never going to buy the bottom unless by accident you hit the buy button instead of the sell button. You will sell the lows and you will buy the highs. You can't help yourself. We're social animals. We like being together. No one wants to be different. We want to go to the bar and all talk about the stocks we own and you get this feedback loop. You really should not assume that you can market time. Are there guys that can do it? I suppose so. I know I'm not one of them. So if I like an idea, I go and I size it. So if I'm right, it impacts me positively. If I'm wrong, I don't go bankrupt. I don't put all my money into one idea. You hear guys who put like 80% of their money in Bitcoin. Like, I don't care if you're right or wrong. It's a dumb idea, right? My kids, I have 4 kids, 2 of them work at, one's at Microsoft and one's at Google. When they get, when they're every year for their, bonus. And I says, you can keep some of this, but the rest of it, let the kick on out of there, man. You work at Google or at Microsoft. Are they going to go belly? Probably not, but you shouldn't have all your investment money in the same place where you're working at. I did work at a company for 26 years that did go belly up, but I never thought what. Merrill Lynch stock went from 98 to $2. Like, I didn't see it coming. I wish I guess I did, and I didn't. So when I got real stock, I would sell from time to time and diversify my way. That's the idea. Size it so it'll make a difference, but not take you down if you will.
Yeah. One of the problems with oversizing a position, you mentioned Bitcoin, is like, it can be the most deadly sometimes if you're right. Because if you're right and you make tons of money, then you think you're really smart, and then you keep this huge sizing and, eventually it blows you up. So, it can be like, sometimes it can be, if you're right at the beginning, it can be even worse.
Bitcoin felt the best at 60,000, didn't it? It was $1 million. We all knew that. So, it's just comments. They're trying to go and take your ego and your emotions and control them. And it's a process to do it. Here are the rules of what I'm going to do. We'll never have more than X dollars in a single name, or X dollars in a single asset class. And that's the rule. And that's it. And you have the rule and you can't break it no matter what. There's a great quote from Ace Greenberg, who was the old head of Bear Stearns. The guy walks in there, the trader, and says, I got this great investment. Well, I put this in there. I want to put more. My risk limits are this, and I want to go put more. Can I do it, Ace? And he goes, of course you can. That's why we have limits. That's so.
I want to ask you about inflation. I'm a big listener of your podcast, and I love listening to you and Mike Green go back and forth on inflation, because you can tell you guys are like really good friends, but you also can go at it aggressively on this. And, we had Mike on earlier in the year, and, he was kind of a believer that, the Fed was going to have to stop soon, and then inflation was coming down. And I guess we got our first, inflation print here that finally came down a little bit. But I'm just wondering if you could maybe talk about, like, your perspective on inflation, where it is and where you think it might be going in the future.
I love Mike. He's a personal friend. He's a work partner. He's the smartest guy I know. And to the extent that he used the word transitory, I would just say that in the grand scheme of things, life is transitory. So it's all a matter of timing here. He was going to be right just literally. My thought was less complicated than his or most other people out there, I suppose. I'm New Chicago. Okay, I want to be in Chicago. I'm a finance guy. Milton Friedman. If you print money faster than the growth of the overall country, the economy, you're going to get inflation. That's it. You have goods, you have money. If you have more money, then, got to balance out. You have to either make more goods or make them more expensive. This is not rocket science. So when the Fed printed money, 10 years ago, a lot of us said, my God, we're going to have massive inflation. We were right, we were wrong. Did we get CPI inflation? No, we didn't. Did we get inflation? Yeah, of course we did. Look at the stock market, stocks, the bonds, the gold, everything went crazy up. We had inflation in assets, not in wages, which was the master plan. The plan was to get wages up. That was the idea. The money just get into the system, into bank balance sheets, and to rest investors. When they did the real helicopter money drop, which was done by both Trump and Biden, right? When they pumped money into the system for COVID and other things, tax cuts, same thing, right? You put money in people's hands who will spend it. Immodestly, I do okay. I get a tax cut of $1,000. Am I going to spend it? Probably not. The average 40%, this is a Fed study, 40% of people, households, do not afford $40 in their pocket for an emergency. 40% don't afford $40 if their car breaks, their washing machine, a baby. This is a public policy disaster, but it's a fact also. When we go and put money into their pockets, it will be spent. And that's what we saw happen. And finally, we printed the money, and then we started directly putting it into people's pockets to spend. The original idea was to put money into people's pockets, into company pockets. Companies would then go and build a factory and hire people and create, better wages. That didn't happen. They stock buybacks, which is a public policy disaster also. It should be, pushed back upon. Well, when we put money into a pocket, we spent it. And so what we're having here is no surprise at all. When's it going to end? This is tricky. Was it going to stay at 8, 9, 10%? Probably not. If it can go to 2, because that's really what a lot of guys are talking about, I don't think so. So is it really bullish for stocks and bonds if inflation goes to 4? No, I don't think so. But can we rally as it goes from 8 to 4? I suppose we can. But I mean, we don't know where the final level of inflation is going to be. And I think that I think wage pressure is not going to abate quickly. Oil is going to come down, and food might fix up, supply chain might fix up. But we have a mismatch here in labor. Demographics is everything. Okay, it's the iceberg of the economy. It's 90% underwater, and it's already built and done. We have baby boomers retiring. Right, the average age is like 63, 64 now for boomers. They're all about to hit retirement age, Social Security age. With stocks up where they were, bonds up, all set up, housing up last year, 2 years ago. Boomers can retire earlier, and they might well do that. And they'll leave the workforce. This great resignation is just boomers doing what they're always going to do. They're just doing it a little sooner. Millennials, what do? They get married, they have kids, they buy a house, they buy baby carriers, they buy a car, all this buying. If you look at the inflation of the 70s, as much as we'd like to say it was Johnson, guns, and butter, there's a Johnson professor, which we're young, who basically spent the Great Society programs. That was when Medicare came. They spent on the Vietnam War at the time. That was not the cause of inflation. Inflation at the end of the day was baby boom generation, all turning 28, 30, 32, getting married, having kids, buying. And who are they buying from? From the World War II generation, which is smaller because one, they were born during the Depression, and we had many fewer babies in the Depression. And number two, they were killed in the war. I mean, they're behind from a smaller group of producers. So that mismatch. So we're seeing the same thing now, where the millennials are in household formation, productivity increasing, and supply of labor is reducing, which leads to, of course, the third rail of politics, immigration, which I've spoken about a few times, and the trolls love to yell at me about this. I'll just say that immigration is good from an economic standpoint. What is GDP? It's hours worked, right, by productivity. People, hours, times productivity. This GDP, nothing less. The U.S. has outpaced Europe and Japan and everywhere else because we have a growing population. One, because we have a birth rate a little higher than replacement, but two, we have immigration coming in. The workforce is growing, and that's it. Now, what immigrants coming in, I have no problem with that. Just be aware of a slower economy. And if you want to make that trade-off, that's okay. But that is the choice you're making here. What immigrants do contribute. They may not pay taxes or something else directly, but when they rent the house, landlords pay taxes. When they buy goods in the store, there's a sales tax. They are paying taxes and contributing money into the system, just not as directly as a 1040. So that's that.
What do you think about the Fed's response here? That's something Mike has been very, very critical of. And, he was also very critical of what Paul Volcker did, back in the 70s too. And I'm wondering, do you think the Fed is being far too aggressive here? Or do you think their approach is pretty appropriate?
As I've written about some of my commentaries, the Fed knew they had a problem last year. Well, March, April, May, they knew that problem. You're already seeing CPI clipping to 5% by, I think, June. The problem is it was a political one, is they're supposed to renominate Powell in August for a quick vote is done. They didn't. They didn't renominate until November, get confirmed until March. And I think he felt his hands were tied, that if he wanted to be the chair again, he couldn't raise rates. Because if he did, the MMT crowd would come after him and I think his nomination. So it's basically, he couldn't raise rates last year like he was supposed to. He had to wait till he got reconfirmed. And the moment he got reconfirmed, boom, he took rates up. It was a political issue that did not work out well for him or the country. Well, I guess he got the problem of inflation. Well, so now he's behind the curve by 9 months, and he's got to catch up. And he's got to get that rate up above inflation to create, you can't have negative real rates. If you have negative real rates, the logic is you build a business, you hire people, you expand because you can borrow money at a negative yield, effective negative yield, right? You borrow money at 5, but inflation is at 4, inflation is 5, borrowing money at negative to slow the economy, you got to get that thing flipped. And that's what he's doing now is just trying to catch up. Well, I think I'm not going to, too much from Mike, but I suspect he will say the Fed policy is wrong right now, which is true, but it's also wrong that they didn't go in earlier. So I think the Fed got themselves into a box they're trying to get out of right now. Will this, slam us into a harder recession? Maybe, but I'm not quite sure what Plan B was. Because as a public policy concept, if you look at the income scale in quintiles, the bottom 20% makes 27,000 less. The top makes 141 and above. They're fine. The guys at the top, they get 40. The guys at the bottom will get government help. They're 60% in the middle. We're getting killed with inflation. Their wages aren't going to budge. They're not getting, big bonuses come year end. Their income is plus or minus, 3 or 4%. We're getting killed by inflation. If we take unemployment from 3.5 to 5, those 1.5% of the people, I feel bad. It's going to be very unpleasant for them. But we have to weigh that 1.5 versus the 60% in inflation. Now, is that equal trade? Losing your job is a lot worse than having inflation. Let's make it, 10 times worse. Okay, now it's 15% versus 60%. We still are better off creating a recession in some one, slow down process and clip down inflation. So they're doing the right thing. It's going to be rough, but I can't say they're wrong. And how do you go tell someone when you're intentionally basically forcing them to lose their job that you're doing it for the home team? Yeah. Doesn't play well. No politicians going to want to say that, but so that's kind of it.
So your general idea is the Fed might be higher and longer than people think, and that, inflation might be a little stickier than people think. Is that fair?
Yes. I think Powell said that. I think Powell said that we're still going to 4.5, 5. We'll just get there in 50s, 25s, which is 75s. That's what he said in the last meeting. And I don't think anyone has said anything else from that. They've said we may have to slow down, but no one has said we're going to stop and go down. I think the futures market that has them cutting rates mid next year is dead wrong. I mean, it's possible, but I don't see that. I think they got us. Yeah, I think they need to get headline inflation to a 4 handle and core PCE to a 2 handle. So 2.9 and 4.9 or vice versa, before they start even thinking about cutting rates. Is headline CPI a fair measure? Of course not. Well, I mean, what else are you going to do? That's what everyone watches, and that's where emotions are built. And so I think that's not taking, it's not going to, we get to 460 on Fed funds and they rest. More plus or minus that level, which puts 2 years at, 440 as a fine ticket. Are you going to make money? Will there be a big downward in rates? I don't think so. But I don't think there's a lot of risk either. And, treasuries are state and local tax free. So California and New York, that's a pretty good deal.
Yeah, absolutely. It's been funny to watch though, because anytime the market seems to get a different idea than what you said, it's like they did in the recent weeks when we got a little rally here. Like the Fed seems to just start parading governor after governor out, to try to get the message across again. So that they're obviously trying to get that message across as best they can.
Yeah, yes. This brings up the concept is it is so much discussion. Is it a public policy good? It used to be that we didn't know what the Fed was doing. They didn't want the darn thing. They would just move the rate by buying and selling securities, and we'd have people have to go to figure it out. These are people look at Alan Greenspan's briefcase, see how stuck it was. Now they're using the dots and everything else. I don't like dots. I think that Greenspan's measured pace from 04 to 06, when he took rates up by 25 basis points every meeting for a year, I think that was one of the key contributors to the Great Pitch crisis, housing crisis. Because by knowing what the Fed was going to do, you could go and lever yourself up and take a lot of risk because you thought, I know what's going to happen here. I'll just bet on that. You could go, if you know it's taking rates up by 75 bits at a next meeting, then you sell the 27 basis point out of the money put. It's free money, right? Until it's not. I think that measured pace encouraged risk taking and leverage and negative convexity. At the end of the day, made things a lot more. And it's still going to be a drawdown. Look how a lot worse because of that. People over their skis. Similarly, what's happened right now? He said, a year and change ago, we're going to keep rates at zero until early 2023. Okay, let's lever up, man. Let's go borrow money and invest in things because I have a zero plus the borrowing and so that. What's happened? It's looked after bonds and where a lot of leverage occurred. The stocks, it's been a slow grind, but what was the max drawdown? 26%, something like that? Wasn't good.
Yeah, I forgot about that thing about holding rates, at zero to 2023. So the world didn't actually turn out that way, as it turned out. I want to ask you about the 60/40 portfolio, because a lot of our listeners will probably be in something similar to the 60/40 portfolio. And a lot of people are saying, in this new world of inflation, you can't just have stocks and bonds anymore. You need to have other things. And I'm just wondering, what is your outlook? Like, what do you think about the 60/40 portfolio going forward from here?
As a concept, I have no problem with 60/40. I really don't. The marketing of it, I do. The marketing was, don't worry, guys, thoughts up, bonds down, and vice versa will soften your portfolio, which was true for the last 20 years. And I have some great charts on my commentaries that show the whole idea of the correlation of stocks to bonds. And basically, from, really the GFC on, correlation, held, where they went in opposite directions. And thus, it was a great portfolio. They both did well. What I learned about, years ago was that if we ever get rates above 3.5, 4, that correlation is going to flip. We have great data. Well, Mike would say it's a good looking chart. I'll say I think it's right. That when rates are above 4, the correlation flips around and stocks and bonds go up and down together. Well, hey ho, guys, the rates just got to 4. What have stocks and bonds been doing? Going up and down together. Like it's not rocket science. Why is that? When you have rates and inflation low, then the discounting of future values is kind of fixed. When rates go up, all of a sudden it kind of matters. The PE becomes unstable. I don't want to get into this equal weight stuff. I'll just get rates up here. You're going to have them moving together. Let's go back down to 2. We'll see 60/40 work as you've advertised. Could you diversify away from that? I have no problem with that nonsense. That's fine. But 60/40 is not dead. It's just not going to work as advertised before. You'll be at risk. Where's 60/40 the problem? It's all the people who used risk parity, where they used leverage. That's where you get 60/40. Okay. So a lot of places would say, I'm going to have $100. I'll put $130 into bonds and $70 into stocks. And that because of various correlation ratios, will balance things out. And I'll do well. And those portfolios have done incredible, up until this year, because you basically own $200 of assets for $100 of investment. So you're going to do well. The problem is if both go down, then you kill pretty quickly. And you'll notice 2 prior times the Fed kind of, pulled the Fed put out of their pocket. There's no D's 2018 and March of 2020. And those are both times when stocks and bonds went down together. And levered money kind of got hurt. And so and when you get your margin calls and everything else, the Fed this time has kind of, waved their hands that, hey guys, we're going up, we're going up hard, get yourself, cleaned up. Well, I suspect there's more deleveraging in most places. 60-40 is fine. Away from this, the products that we offer, I would tell someone, go 60-40 in your 401k and call me in 20 years.
It'll probably be fine. I want to ask you, a lot of people are familiar with the VIX as a measure of stock volatility, but less people are familiar with the measures of bond volatility. You actually are the inventor of the primary measure of bond volatility, the MOVE Index. So I'm just wondering if you could talk about what the MOVE Index is.
I love the MOVE, man. So we created it in 1994, I think it was. When the VIX was coming out, because the VIX came out, I looked at that at the time. I'm running the optional business at Merrill Lynch. And I say, this VIX is great. It's a way to, I won't say dumb down, but really dumb down the whole, risk of volatility to a single number that everyone can talk about and kind of get. Are there bugs in it? Yeah, sure. But the idea was so genius to do, and it was winning to capture the big idea. I said, I'll give you this thing with interest rates. And so we built the MOVE, which is functionally identical to the VIX for vol. The applied volatility, one with options on a bunch of bonds. It's actually a real number. But the MOVE at 100 basically means that a 68% probability went up or down 100 basis points from here or a year from now. What's their deviation? What's more, and right now with the MOVE at like 150, or that's where it was last week, what means like 68% chance will be up and down 150 a year from now. What's clever about both the MOVE and the VIX is you can deconstruct them into a daily number, because the numbers are both quoted as annual. And so if I deconstruct it, like I say, I can divide by 16, well, 15.9 technically, which is the square root of 252, number of trade days per year. Well, I take 150 and divide by 16, I get like 9. That's what the market was saying bonds were going to do every day, close to close, 5 basis points. The VIX at 30 is basically saying we're going to move almost 2% every day, close to close, which is why you don't see the VIX at 30 too often, because 2% every day for a month, that's pretty harsh, man. And the same kind of thing for bonds. I mean, you can't move, not it's every day for a month. Their head will blow up their necks, which is why it never stays high that long. The move for, first 10, 15, 20 years, 80 and 120. The rule was to buy at 80 and sell at 120. The problem is it never happened because the move got to 120, you're hiding under your desk calling for money. So it didn't work. But that was the idea. Anything with the VIX, it's up to 40 or 50. I mean, supposed to go and sell it. Are you going to do it? You're not, because you're in a panic at that stage of the game. But I mean, the reality is, that's kind of, it's almost an inverse signal. Some of the VIX at 9 or 10 or 11. That's idiocy, man. I mean, that's way too low. So you should be buying protection at that stage of the game. So that's all there is to it. Well, the move's going to come down soon enough. Well, it might even be down now. I mean, really down for the count, because we kind of know, I don't know where the top's going to be. We kind of know somewhere around 5 is going to be it, unless we really get inflation accelerating up again. For stocks and bonds, investing per se, we don't know how long it'll be there for. That's the next question we don't know. But as far as the speed, we kind of traveled most of the distance, which is why you're seeing these big moves in stocks and bonds.
I know there's not a direct relationship there, but is there any truth to this idea that like bond volatility might tell us what might happen with stock volatility? Like people this year have been saying, well, the move's really high. That tells us, the VIX is going to spike eventually. Is there any relationship there at all? Or is there nothing behind that?
There's a lot behind it. It's not tradable. Don't trade it. But there is a grand correlation. If you look at the big risks in the market, I will say that there's duration, credit, convexity. Duration is when you get your money back, like 2 years or 10 years, 30 years. Credit is if I get it back. Is the bond going to default or not? And the convexity is how I get it back. It's the path of how we get going. And those three risks, duration is measured by the yield curve. Credit is measured by the spread, like junk bond spread. And the convexity is the move or the VIX. Those all tend to go up and down together. Well, so if you look at big charts, they all go up and down at the same time, but they don't. There's no like 1 month lag, 10-day lag. You can't trade it. But you can do is move and do asset allocation around in a big way. And I think if you had a giant supercomputer that trade the market, you would see it move between duration, credit, and convexity in some kind of pattern. Go and do it. Like right now, what am I telling you to do? Well, it's entertainment only, no advice. But I love mortgage bonds here. Mortgage bonds have no credit risk. No credit risk. They have duration convexity risk because you don't know if the mortgage bond is going to pay off in a year or 30 years. More like a year or 7 years. That's more of that for now. And with a move up at 150, I'm selling optionality at a very high price. We're selling big options at a high. I'm doing a buy right on bonds basically, but the option I'm selling is not 1 or 2 months. It's like 7 years. And that's why you have a spread of 175 over treasuries is because that option is exploded in price. I'm going to go sell that option. I'm going to buy mortgage bonds, take no credit risk because we might still have a recession, actually will have a recession. But I don't want the credit risk. I want that kind of big convexity risk. Yeah, I don't want to sell short-dated options because the volatility is too quick. But longer vol is a good sell.
Justin's going to ask you more about mortgage-backed securities in a second because you wrote a really good article about it recently. But just before I finish, I just wanted to ask, is there any possibility there will be like move futures in the future? Like, could there ever be something like the VIX or is that not possible?
Never going to happen. Because you don't have the underlying instruments to be the hedge. You'll notice you cannot trade the VIX. You can trade VIX futures. You can't trade the VIX. Options on VIX futures, right? But you can't trade, the options on the VIX per se. But you do have a very active market in VIX futures, VIX options, and in, options on, the individual stocks that comprise your street. You don't have that in bonds. You have 1 month options on bonds, but we're not transparent. They're only institutional. And you're never going to have that. So, and I've been called by the CME, CBOT. They've been calling me for 30 years now to do, move futures. Like, not going to happen.
You referenced that paper where you kind of walk the reader through the process of creating mortgage-backed security from the time a person sort of buys the house. Is that something you can just kind of explain?
Sure. So the housing process is a 2 to 6 month process. So the person wants to buy a house. My daughter's looking for a house right now. My daughter's looking for a house. They go to the bank. They go to some institution. It could be a bank, it could be a broker, and they say, I want to borrow money. I want to pre-qualify. And they figure out how much they can borrow, on their income, and their credit scores. Once they know that number, they can look for a house. Once they find a house, they say, I want to buy it. And they sign a purchase agreement. When they sign that, they immediately go back to the bank or broker and they say, I want to borrow the money and lock it in. And they'll give you a rate and lock it in. That rate usually locked for 2 months. really long, really 2 months. Well, now you got to go and inspect the property, do all this nonsense. I mean, it takes 2 months to go close a house, at least. From the time, unless there's some quick close for cash, which is rare. And then once the house is sold, the loan closes. Well, now whoever had that loan, and it's not banks anymore. Yeah, you have JP Morgan and Wells, but really it's mostly like Quicken and Loan Depot, making these loans. They're not banks. They don't make loans. They make a loan and then sell it. And they go to Fannie Mae immediately. You give it to Fannie Mae, Freddie Mac, or Ginnie Mae. They're the government agencies that go and guarantee loans. Loans go there. They get examined. They usually go through because these loan non-bank brokers, they know what the rules are. Fannie Mae has a set of rules there for the loan to qualify. And they rarely make a mistake on that because they don't want to own the loan. Because if they keep that loan, they're in real trouble. And then Fannie Mae looks at it, they stamp it, they put together $1 billion pools, thousands of loans, tens of thousands of loans, hundreds of thousands of loans into a pool, and they go back, and then the bond gets sold into the market to Goldman or Merrill Lynch or Goldman Sachs, whoever it might be. They then sell it to a mutual fund, a Fidelity or Vanguard or PIMCO or BlackRock. And this whole thing takes, 3 to 6 months to do. It will take time for all this to happen over here. I don't know if it's dirty business, but it's what it is. The thing is this, that point in the middle where I said that the non-bank makes the loan, they know where the Fannie Mae loan bond trades in. That's their exit strategy. They then price the loan X basis points above that, which includes all the fees and everything else to go do this stuff. What tends to be 75, 85 basis points. It got as wide as 125, a few weeks ago, but it's back into about 85 now. And therefore that means since banks are not making the loans directly and keeping the loans on their books, the entire mortgage business prices off of where Fannie Mae and Freddie Mac bonds trade in the market. And those bonds that were trading 40 basis points over treasuries went to 175 over. And that's why you saw mortgage rates just explode off the map, because mortgage bonds go up. Well, Loan Depot and Rocket got to go up also. And the cost of doing all this stuff increases. Well, they widen the spread from 75 to 125 over. That's why I'm seeing a 7% loan over here. It's going to come back in. What I want to do now is buy those Fannie Mae bonds. I think they're the wrong price. And the levered way to do it is mortgage REITs. So the exact same trade, we're level number one. Full disclosure, these bonds are levered. They're volatile. They do a lot of bad things. Be careful with these things. I like them because they're a way to go and buy that Fannie Mae, Freddie Mac, one sort of overwhelmed and own it 7 to 1 levered. So I like that. What can make this blow up? If the Fed decides that 5% is not the top and they take it to 6 or 7, that could do it. If bond prices overall just vacuum drop down by 50 basis points in a week, that might be a problematic also, because they have to manage the hedges on these things. But I think that there's a lot of cushion now, which I describe in detail in my paper. Yeah, it's a risk I'm willing to go and take for a, not betting the ranch, but good enough for if I'm right, it'll be okay. It is difficult for civilians to buy mortgage bonds directly. The best one out there, I think BlackRock has one out there. But they look it up. It's a tricky one if it's the mortgage index. So the coupon on that thing now is like 2.5, which doesn't make sense because mortgage bonds are like 5%. It's 5.5% now. So it's weird. The reason why is the mortgage bonds are all traded at 83, because most mortgage bonds are actually 2s and 2.5s from rates that were created that were 3.25. Well, theoretically, these bonds, these ETFs will deliver a 5 and change % total return. So you'll get 2.5 of coupon and 2.5 of pull to par. from $83 price bond going up. That's what I think about this. And rates you're gonna see mortgage rates. The whole thing's gonna collapse on down, not in a bad way, in a good way, because if you take rates from 3 to 7 for a homeowner, the math is very easy on what they can afford. And I wrote about this. They take rates from 3 to, I think I did 3 to 6.5 in my commentary. That basically means that a house that was affordable, $500,000, is now going to be like $350,000 to go and make everything else equal. An ordinary civilian, his income is not going up by a lot. We can afford $2,000 a month. That's all you can afford, $2,000 a month. We don't, with $2,000 a month, I know much I can borrow. It's really easy. Go to your Bloomberg or internet mortgage calculator. Back into $2,000 can buy this 3% at 0.5%. And that's why you're going to see the housing market grind to a halt very quickly. Rich guys can go and buy all the houses they want for cash, but ordinary civilians, this is going to really slow things down. Now, will you see housing come down by 30, 35%? No, you're not, because you're not going to see massive housing selling like we saw 12 years ago. You're not going to have bankruptcies, because people that bought houses in the last 5 years, they all qualify. You're not giving loans to people who don't qualify. Well, that's almost illegal. And if you have a 3% loan, you're locked in, man. So you're not moving.
We'll put a link to that. You really do flush it out a lot more in the paper. So we'll link to that in the show notes here for people that want to read it. The title of the piece is A Deep Dive into Mortgage Bonds. It's your November 3rd posting on your website. So, Harley, thank you very much for this. We like to ask all of our guests sort of a standard closing question, and that is, based on your experience in the markets, if you could teach one lesson to your average investor, what would that be?
Oh boy. I mean, I writ large, I think you're supposed to go and know what you know and know what you don't know. And if you make your money doing some kind of certain function or specialty in the world, go and do that. It's unlikely that you're a professional stock picker that can pick single name stocks. The time you've heard about the story of any stock by the taxi driver, the story's probably already over. So, be diversified in what you do. Doesn't mean you index per se, but be diversified in what you do, and don't place all your eggs in a single basket. And then finally, try to control your ego, which is against your nature, but try to control that. It was very hard to, especially when you're in a group of people, to go and, not everyone with all of them. Be careful about that.
Excellent. Thank you very much, Harley. We appreciate it.
Thank you.
Hi guys, this is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at JJ Carbonneau. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.